welcome back to my YouTube channel. In today's video, I'll be showing you guys the step-by-step process which I take to actually analyze my trade down to execution and exit. Okay, so this strategy is actually a very good strategy for gold. Right, so you can see that gold has actually been in a downtrend for a very long time. So you can see that the market has actually been trending downward. And now what happened? We just have a shift in trend. So how am I able to actually identify that this is actually a shift in trend? Okay, how do I know that this is actually a shift in trend? Okay, we have a break of this Friday high, okay, and we have a high low. Okay, the market was actually trying to go down, and then we have an impulsive move. Sunday opened with a gap, and then market came back and filled that gap. So what I'm actually expecting and anticipating is for the market to actually continue to push to the upside. So mind you, in a few minutes from now there'll be a news. I just hope it's actually favorable for me, that it supports my price action and push the market to the upside. So guys, before we move to the chart impact, okay, this was a live trade, and if you can see, the market is actually still moving. So this was the setup I showed you guys, and right now it has actually played out and actually smashed my TP. Right now I'm still waiting for another opportunity right here. So it's not something that is hard, hard or difficult. So anybody can actually really replicate this. So if I don't get any setup today, hopefully I'll still be able to get the setup to still follow my trading strategy. Okay, so before we proceed, all right, so here's gonna be my stop loss, because I have this swing low right here. This is where the breaker block is. So here is the liquidity pool, and here is going to be my target. I don't know, the market might actually break further and give me all the setups, but for now this is what I'm actually looking at. So right now, let's go back to the chart. Let's go back. Let me explain and give you this strategy from beginning to end. Don't forget to hit the like button and subscribe. Watch this video to the very end. So guys, first we are going to start with market structure. All right, so what is market structure? Market structure theory suggests that market has actually three phases. We have the uptrend, we have the downtrend, and the consolidation. So what's an uptrend? An uptrend market is a situation or a scenario where the market continues to make highs and lows, highs and lows, highs and lows, where the market continually break what structure to the upside, where the market continuously break what structure to the upside, and it continues in that series breaking structure to the upside. So you might ask, where does the break of structure happen? The break of structure is happening right at this particular area right here. That's where the break of structure is happening. So you don't have to confuse yourself. Nothing too complicated about this. All right, so the break of structure, it's actually happening right at this area right here. Right here we have our break of structure, and also right here we're having a break of structure, and this particular area is where the break of structure is happening. So let me zoom in a little bit so that you can clearly see it for yourself. So for an uptrending market to happen, the market must continuously make what high, low, and then high, and then low, and then high, like that. So this must continuously happen for the market to continuously be in an uptrend phase. So likewise, for a downtrend, the market must continuously is an inverse of the uptrending market. The market must continuously break structure to the downside. Like right here, you can clearly see that the market broke a structure to the downside, and the break of structure is actually happening right here. And right here we have a pullback, and the break of structure is happening right at this area. For the consolidation or the ranging market, here nothing is actually happening. We just have the buyers and the sellers. So the buyers are below, the sellers are below. So what this signifies, it signifies indecision in the market. So what might actually happen is the market can either break to the upside grab the liquidity resting above there and then drop to the downside, or the market can actually drop to the downside, grab the liquidity and push to the upside. Okay, grab the liquidity and push to the upside. So it's just simple, right? So for this particular ranging market, we actually avoid that. We have nothing to actually do with this particular one, so we just avoid it in totality. We focus mainly on the uptrending market. Okay, we focus mainly on the uptrending market and also the downtrending market. So this is our major focus. Next thing you need to know is that the trading market is made up of what? Two main parts. We have the impulsive move where the market is actually pushing to the upside, and the corrective move where we have the market pulling back to the downside before the impulsive move. So basically for an uptrend, we have the impulse, corrective, impulse, corrective, impulse. So this is what an uptrend entails. So in case you're actually on a buy and then the market is pulling back, it doesn't mean that the trend is actually changing. It means that the market is actually correcting for it to continue pushing to the upside. So where does the break of structure happen? The break of structure is actually happening right here where we have the break of structure. We have the BOS, right? We have the impulse, which leads to the break of the structure before the corrective move, and then the impulse again. So it's just simple. So now where the question is, how do we identify when there is a change of trend? For us to actually identify when there is a change of trend, we need to follow this simple rule. So for instance, the market is actually pushing to the upside. So to identify the change of trend, we have to see that the market sweeps this current low. So if the market sweeps that current low, therefore we have a market structural shift, okay, a change in direction of the trend. So this is a market structural shift that is going to lead toward more lows to come. So this is a market structure shift, not a break of structure. Yeah, so we have our market structure shift. So since we have a market structure shift, what next are we looking for? We look for a pullback, and then the market continues in this series to make lower lows and lower highs. So the market shifts from the impulsive phase, from the uptrend toward a completely downtrend. So you see that the market shifts from the bullish market to a bearish market by what? Just a shift in market structure. So we have a break of structure to the downside, and this corrective phase, some people might actually think that this correction is actually the market ready to continue pushing to the upside, not knowing that it's actually correction for the market to continue to sell to the downside. So the impulse is just the reverse of what is actually happening on a bullish trend. So it's the bearish trend is just the reverse of what is actually happening on the bullish scenario. So it's just the reverse, where we have the impulse and then the correction, the impulse, the correction. So right now we're going to look at something different. All right, we're going to look at something different. We're going to look at liquidity. Liquidity refers to orders in the market or money. Liquidity is what makes the market move. Without liquidity, the market cannot actually move. Okay, without liquidity, there will be no money in the market. You and I make money in the market because of what? Liquidity. So for us to buy, there must be what? For the market to move, there must be what? Buyers and sellers. So there are buyers, there are people ready to buy right here, and also there are people ready to sell at that extreme right there. So since there are buyers and also there are sellers at these levels, so what do we look for? For what do we look for? We look for a liquidity sweep, all right? Because at this area, there are what? Stop losses resting above, and also below here, there are stop losses resting below. All right, so for their buyers resting here, okay, so below here we have buy stop orders, sell stop orders, and stop losses. Okay, so right now, let's say already retail traders are already selling from this area. So what happens? The market ended up sweeping them off and then doing this exactly and then pushing to the downside. So this is what happens majority of the time, and if you check your chart, this is what still happens, and this is exactly what I use in taking my trades. Okay, so now let's look at the bullish scenario. So for the bullish scenario, there are stop losses resting below here. What happens? The market take out the stop loss and even the sell stop. Okay, the market take out those sell stops resting below, and what happened? The market pushed to the upside, just something like this. Okay, before the market moves. So it's just simple for you to actually look for this strategy on every day-to-day basis, because it keeps appearing what on the market. So this is actually the setup which we are going to be using for this particular trading strategy. So for this particular strategy, you can imagine that the market is actually breaking structures to the downside. You see that the market is breaking structure to the downside, and we have equal lows. So for an equal lows, it indicates that what there are stop losses resting above, like as in this area, there are stop losses resting here. So what happened? The market have to sweep the liquidity resting above that area to go to what the supply zone, okay, to go to the supply zone before actually selling to the downside. So let me just go ahead and edit that. So that's the supply zone. The market goes to that area and then drops to the downside. Okay. All right. So the market drops to what the downside. So it's just a simple approach. Okay. And here is your target. There is a supply zone, because at that area, that's where you utilize your supply and demand strategy. So if you reverse this, you're actually going to look for demand, okay, for the inverse of that. So let's look at another example of this same setup. So for this particular scenario here, we're just going to focus on this first. So for this, we have a break of structure to the upside. And where is that break of structure actually happening? The break of structure is actually happening at this area right here. Okay, we have a break of structure, and the break of structure is happening where? At this particular area right here. So here, this area, we are marking it out because since there's a break of structure of that area, here becomes what? Our breaker block. As you're going to be seeing me using this particular system on the gold chart. Okay, so this is what I use in actually entering the trade setup, which I showed you guys. And see, we have a pullback, and this pullback, this is a double bottom. Okay, and there is liquidity resting below. What happened? The market taps into a breakout block and moves to the upside. So like I said, there is always a candle, a swing, a high low candle within this area on the smaller time frame. So that's where you hide your stop loss, so that the market is not going to liquidate you. So now looking at another example, okay, these are the different strategies or patterns which I actually trade. So for this particular one, we have what? A sweep of what? Liquidity, break of structure, all right, a pullback. This pullback is what gives us what? Our transactional what? Liquidity, and then we have another break of structure. Okay, so this a second break of structure is actually to verify that the market is actually in an uptrending phase. Okay, the downtrending phase is actually over. So you actually take the trade upon the sweep of what? Liquidity, and then getting into our demand zone, and then you take the target to be actually that. So that is just a simple approach from A to Z on how to actually implement this strategy. Anybody can actually do this. All right, you can actually do this yourself too. All right, just master the pattern just so that you can be able to implement them in your trading. So now let's go back to the gold chart. All right, so right here I'm going to show you guys something. Let's go back. Happened Tuesday last week. Yeah, if you come here, 25th was actually Tuesday. Okay, so you can actually see that was Tuesday last week. So I won't know it so precisely if I don't take this trade. We have a sweep of market structure shift. These are market structure shift right there. You're looking at it. So we have a market structure shift right there. Right, since we have a market structure shift, Okay, next thing we're looking at is the market pulling back to our what? Supply what? Zone. Okay, so market push back to our supply zone. All right, so the next thing we look for is actually a break of structure. You can actually still take a trade there, but I don't actually trade that way. It doesn't give me confidence because there's no liquidity to take out. All right, I love when the market takes liquidity. All right, sometimes I'm the liquidity too if I don't make my etc. So we have a break of structure right there. All right, so within this area, if I go to the 1 hour chart, you'll be able to see my breakout block right there. So there's a breakout block, all right, the bearish breakout block. Okay, so because the market was actually supposed to come test this and then keep pushing to the upside, but it failed by sweeping through it. Okay, and then we have our equal highs or whatsoever you call it right here, and then that signifies what? There is liquidity resting above that area. So there's liquidity resting above this area. So what happens? The market goes, kiss that area, and if you go to the 5 minutes time frame, you'll see a confirmation candle as soon as the market kiss that area. All right, let's look at the confirmation candle. So you see that confirmation candle, fam. So you see, you just take your trades, simple stuff. Okay, I advise you to stick to one pair. You can just stick to gold, GU, US30, anyone. This particular strategy work for it. So I love 30 pips, 40 pips here. So you see, it just delivered, fam. So it's just as simple as that. You can actually implement this, but you just have to study. It's not that easy to actually understand this particular strategy. So, and then there was another unique trade which I took on Friday. Okay, so what is that unique trade? All right, so the Friday trade is actually the same pattern. All right, so for this one, I don't need a shift in structure. All I need is what? A break of structure. Okay, all I need is what? A break of structure. So right here, I have what? A break of structure to the downside. So since I have a break of structure to the downside, what next am I looking for? I'm looking for a liquidity zone. So there's liquidity resting above that area that needs to what we taking out. So what happened? The market came, swept that liquidity. And right now, I'm just going to go ahead and mark my breaker block. So I'm just going to go ahead and mark my breaker block. So I'm just going to go ahead and mark it out. So I mark that area. So you see what happens? The market just comes, taps into it. Okay, all right, taps into it and just tank all the way to the downside. Sometimes I just prefer 20 pips, okay, because it keeps me safe. Okay, so you see your TP1 would have been smashed, and then so you'd have just ended the week in massive profit. So you see that was Friday. All right, this happened around the New York session. So see that, and then so what happened here? We already identified why the market actually shifted into trend, and then here you traded with me. You saw me when I entered this. We're just here, okay, when I was talking, and what happened? The market actually pushed to the upside. So for this particular area, what I did was actually use the 3 minutes to actually mark this breaker block. Okay, I used the 3 minutes to actually mark the breaker block. So if I had gone for 20 pips, I think it would have been smashed. Okay, but I just choose the safe route. So it was just a very simple trade. So don't forget to hit the like button and subscribe for more and more videos like this. Okay, so see you guys in my next video.